If you've just clicked on this video, you're probably going to want to know what private equity is.
What is this? What is this? Where's all the money? That's as good as money, sir. Those are IOUs.
Let me break it down for you really simply. You've probably heard the phrase private equity, and you've probably seen it in shows like Billions or Suits, usually involving billionaires, boardrooms, or dramatic power plays. That's not what it really is. Private equity is when investors buy a business, improve it, and sell it later for more than they paid. And it sounds really simple, but it's what happens inside those deals that I'm going to focus on today. Let's get into it. Hi, I'm James Pearson Garner, and on this channel we cover what private equity actually looks like behind the scenes, from deal strategy to value delivery. So section 1, what is private equity? Let's start it really simply. Private equity, or PE, is when a group of investors buy a company, trying to improve it, and then sell it later for more than they paid for it.
I want more. And I know I shouldn't.
That's it. That's basically private equity in a nutshell. This is how a lot of businesses grow so quickly across the globe. I'll just give a quick analogy. Imagine you're buying a house. The kitchen's quite tired, the heating's inefficient, and the layout doesn't work with what your needs are right now. So you're going to make some renovations, you're going to modernise it, so you're going to sort out the insulation and make the house more desirable. Ultimately, selling it for more than you bought it for. Now, if we take that analogy that I've just used with the house and change it for a business.
I'll make that deal.
Now, to make that analogy work for the business, you're improving its operations, you're fixing cash flow, you maybe bring a stronger leadership team in, maybe changing the commercial model, and ultimately making it more valuable for that next owner. Now, who's actually doing this? Private equity firms don't usually buy businesses with their own money. They raise capital from big institutions like pension funds, insurance firms, family offices, or high net worth individuals. These investors are called limited partners, or LPs. The PE firm, private equity firm, known as the general partner or GP, manages that money through a fund. They go out to find businesses to buy, help improve them, and aim to sell them within 3 to 5 years, hopefully for a solid return. Most of the businesses that they buy are private, which means they're not listed on the stock market, and that's a huge advantage. It gives the private equity firm much more flexibility. They're not worrying about quarterly results or share prices. They can make bold decisions quickly, restructure things, invest where it matters, and focus purely on growing value. Sometimes they'll buy a public company and then take it private. That's called public to private deal. Once they've done that work, they might relist it on the stock market or sell it to another buyer. And these types of deals are becoming much more common in the UK. I'll walk through a real world example. So let's say a private equity firm has bought a specialist manufacturing firm. It does £30 million a year in sales. The leadership team is overstretched and the company is selling too many different products. So it's not managing cash flow well, it's using too much working capital, and it has no real plans to progress and add value over the next 3 to 5 years.
That's as good as money, sir. Those are IOUs. Go ahead and add it up. Every cent's accounted for.
This is where the private equity firm would step in. They'd simplify the product line, they'd bring in a new CFO, they'd renegotiate supplier terms, improve pricing, and then help the company win bigger contracts. Maybe they'd invest in automation, and then 2 to 4 years later, they would sell that business, either to another private equity firm, a bigger strategic buyer, or through a listing. And that profit would then get shared with their investors. And the goal is always the same, it's to create value. Now, to be fair, private equity used to have a reputation for just cutting costs, loading the business up with debt, and then selling it. And sure, that still happens in some corners, but the best firms are focused on actual operational improvement, working closely with the management team to unlock that real potential. So I'm just going to do a quick recap of section 1 and then move on to section 2. So we discussed private equity is about buying businesses, improving them and selling them for more. It's funded by investors like pension funds, LPs, managed by PE firms, GPs, and delivered through dedicated funds. And I gave the housing analogy to help summarise how these models work. So how does private equity firms make money? So now we know what private equity is, which is buying businesses, improving them and selling them for a higher return. Let's talk about how private equity firms themselves make money. Because it's not just about buying low and selling high, there's actually a structured fee model behind it, and it's designed to reward both effort and performance. There are two main ways a private equity firm makes money, which is management fees and carried interest. So I'll start with the management fee. This is basically the firm's income for running the fund. It's paid by the limited partners and is usually around 2% of the total fund's size, charged annually. Let's say a private equity firm raises £500 million fund, they typically collect around £10 million a year in management fees alone. That covers the cost of running the business, which is salaries, overheads, sourcing deals, legal, due diligence, travel, and anything else. These fees are paid whether the deals perform or not. That's why some people say it's a bit of a safety net. It gives the firm consistent revenue while they go out and try to generate returns. Now, on the second hand, and far more lucrative, is carried interest. Carried interest is often just called carry, and it's the performance-based bonus. It's the share of the profits that the private equity firm gets once a deal or fund hits a certain amount. Typically, this is 20% of the profits, but only after what's called a hurdle rate, which is usually around 8%. And this just simply means that investors get the first 8% of their capital before the private equity firm earns any carry.
Hey, fellas! Look what I found in my pocket! Look! A year's salary right here! What I call them? Fun coupons!
So here's a simple example. Let's say the firm invests in a company and eventually sells it. That sale generates a 3x return. After giving the investors the capital and that 8% hurdle, the firm might then take 20% of the remaining profits as the carried interest, and that can add up really quickly, especially across multiple deals in a fund. This is where real wealth is made in private equity. It's not from the management fees, it's pretty much from the carry. But not every deal hits carry. There is always a risk with carry, and that's why management fees exist. So that's how private equity firms make money. If I just do a quick recap, private equity firms earn a management fee. That's a fixed annual income, usually around 2% paid by the investors. They earn carry interest, which is a share of the profits, usually 20%, but only after hitting a minimum return. And in some cases, they might charge deal or advisory fees. This is more tightly regulated in today's market. So as always, if you're finding these useful, please do give the video a like, hit subscribe, and stay with us along the rest of this PE series. Let's keep going. So section 3, the different types of private equity deals. So far, I've talked about what private equity is and how firms make money, but not all private equity deals are the same. In this section, I'm going to break down the main types of private equity deals, the different approaches firms make depending on what type of business they're buying, and then what kind of return those deals would aim for. So the big four: 1, leveraged buyouts; 2, growth equity; 3, turnarounds and special situations; and finally 4, buy-ins and build strategies. Now I'll walk through each one of them. The first was leveraged buyouts. So this is the most well-known type of PE deal, especially in the UK and the US. In an LBO, the private equity firm buys a business using a combination of its own capital and a significant amount of debt, hence the word leveraged. The idea is that by using debt, you amplify your returns as long as the business performs.
And you're selling something that you know has no value.
We are selling to willing buyers at the current fair market price.
Now, when people hear debt, they often think risk, and that's fair, but in private equity, debt is used strategically. It forces discipline and it makes sure the companies run efficiently. It adds interest payments, which are often tax deductible. That could be helpful from a cash flow perspective. You'll often see LBOs in stable cash generating businesses. Think B2B services, manufacturing, healthcare, infrastructure, anywhere where a business has predictable earnings that can support the debt and still invest to grow. A classic example is a PE firm buys a £100 million revenue company, finances it at 60% of the deal with debt, improves performance, pays down some of the loan, and then exits 2 to 5 years later with a stronger, more valuable business. Number 2, growth equity. Growth equity is where the private equity takes a minority or non-controlling stake in a company that's already growing. These are usually in tech, consumer, or digital services, and they provide capital to help scale faster. These companies are often profitable, but they need cash to expand. This can be used in a number of ways. You could be opening new locations, you could be investing in new products, you could be using the money to scale their sales team, or potentially enter new markets. The key difference here is it's less about fixing a problem business and more about accelerating one that's already working. In the UK, growth equity is popular with founder-led businesses who don't want to sell the whole company but need support or capital to take them to the next step. Three is turnarounds or special situations. This is a more hands-on, often stressful side of PE. These are companies that may be in distress, have cash flow issues, operating problems, real legacy, reputational things, real reputational damage that they're trying to recover with. These are far more riskier, and if you set them up right, the reward is huge. Turnaround specialists look for businesses with good fundamentals, so this means strong products, loyal customers, but often have poor execution, so bloated cost base or a leadership team that's lost control. How a private equity firm would fix this is they normally bring in a new management team to come in, restructure the business, clear up the balance sheet, and reposition the company for a recovery and for growth. These are the deals where operational skills matter the most. It's not just financial engineering, but real leadership and execution capability. And finally, buy and build. So these are platform deals. Buy and build is where a private equity firm invests in a platform company. For example, an accounting software firm. The private equity would then help that company acquire smaller competitors or complementary businesses. This strategy is all about consolidation. You take a fragmented market and bring companies together under one roof. So this is driving efficiencies through scaling. An example would be you share the services of the other companies that you've bought. You share their systems. So you might bring all the systems together. That creates efficiency. You could have economies of scale, so better buying power. You see this type of strategy in a lot of sectors like healthcare, education, professional services, or IT managed services. It's always areas where there is a lot of small founder-led businesses that can be rolled up into something bigger. In the UK, buy and build is a common approach in lower mid-market PE, especially in services or tech where scale drives valuation. So let's just do a quick recap of section 3. There are 4 main deal types in private equity. One is leveraged buyout, the classic model using debt and enhanced returns. Growth, which is minority investment in a high growth business, often founder led. 3 is turnarounds. This is high risk, high reward plays focused on underperformers. And finally 4, buy and build, consolidating smaller firms into one scalable platform. Each approach needs a different sort of playbook, but they all rely on the same fundamentals: backing the right team, having a clear plan, and executing fast. In the next section, I'm going to go into the anatomy of the deal. So this is how private equity firms actually source opportunities, run the due diligence, and structure the deal and close it. So what is the anatomy of a private equity deal? Now that we've covered the different types of private equity deals, let's look at how the deal actually gets done, from finding the opportunity to closing the transaction. There are 5 core stages in the anatomy of PE: sourcing, due diligence, valuation and structure. Sourcing, due diligence, valuation and structure, deal execution, and transition to ownership. Let's walk through each one. Sourcing the deal. It all starts with deal sourcing. Basically, how private equity firms find companies to invest in. Some deals are proprietary, meaning they're sourced directly from relationships with founders, advisors, or industry insiders. These are great because you're not in a bidding war. Other deals that come through are intermediaries. So these are things like investment banks, corporate financing boutiques, and M&A advisors. These processes are competitive and often run through structured auctions. In the UK mid-market, it's a mix. So a strong PE firm will have a network of advisors, founders, and CEOs constantly feeding opportunities into the pipeline. A great sourcing is all about relationships, reputation, and timing. Number 2, due diligence. So once a potential deal is identified, the private equity firm dives into a due diligence. This is where they lift the bonnet and inspect every single part of the business. I do mention these in some of my other videos where I talk about a cost to serve model, a margin accretion cube, and there are typically 4 key work streams in due diligence. Commercial due diligence, which is there a real market? What's the competitive position? What are the risks? Second is financial due diligence. So are the numbers clean? Are there any surprises in cash flow margin or working capital? You've got legal due diligence, which is are there any contractual issues, liabilities, or compliance risks? And finally, operational due diligence. This is what's the quality of the processes, systems, supply chain, tech stack, and people. This phase is about spotting both the value opportunities and the landmines. A good private equity firm will be looking at the upside, but they'll also be brutally honest about what's broken. Number 3 is valuation and deal structure. If diligence stacks up, the next step is working out what the business is worth and how to structure the deal. Valuation PE is often based on multiples of EBITDA, which, if you missed it earlier, stands for earnings before interest, tax, depreciation, and amortization. So a business doing £10 million of EBITDA sells for a 7 multiple, which means it's worth 70 million. But that number then depends on the sector, growth rate, margin rate, risk, and competitive process. Then there's a structure. How much will be paid in cash? Will there be earnouts? Will there be deferred consideration? Will the founder roll over equity and stay on board? And then there's the debt. If it's a leveraged buyout, the firm will bring the lenders to finance part of the purchase, which boosts returns but also increases risk. 4 was deal execution. Once terms are agreed, the lawyers and advisors then take over. So share purchase agreements then get drafted, debt is financed and finalised, warranties and indemnities are negotiated, and all of the closing mechanics are then lined up. This stage is about de-risking the transaction, making sure there's legal clarity, tax efficiency, and a clean-up path to start day one. In the UK, this can take anywhere from 4 weeks to 4 months, depending on the complexity of the deal. Then there's 5, transition to ownership. This is where the firm steps in to support the business, usually through board governance, access to networks, and by driving value creation plans. We'll get into that detail in the next few sections. This is also where key challenges start to land. A new CFO, systems upgrade, strategic resets, incentive plans for the management teams. The goal at this stage is to stabilise, align, and move fast. There's typically 100-day plans in place, and we've got a full video on that if you want to go any deeper. So a quick recap. The anatomy of private equity deals break down into 5 key steps. Sourcing, which is finding the right deal at the right time. Diligence, which is validating the opportunity and exposing the risks. Valuation and structure, agreeing on price, terms, and how to fund the deal. Execution, getting it over the line cleanly and efficiently. And lastly, 5, ownership, where the value creation phase begins. Getting this right is what separates a smooth investment from a nightmare. It's where discipline, experience, and judgment matters the most. In the next section, we'll talk about exactly that, value creation. How do private equity firms actually improve the businesses they buy? If you're getting any value from this so far, please hit the like button and subscribe to the channel. It really helps. Let's keep going. Section 5, value creation. Right, so you've bought the company, the deal's done, and now comes a part that actually matters, which is creating value. Because buying a business isn't the hard bit, it's improving it. In this section, we're going to talk about how private equity firms actually grow the value of the business that they invest in. And here's the key point. Value creation is never an accident. It's planned, tracked, and delivered, usually over 3 to 5 year period, depending on the strategy.
Not quite my tempo.
So what is value creation? At its core, value creation is about making the business worth more at exit than it was at entry, and doing that in a sustainable, measurable way. This usually comes from three sources: revenue growth, margin improvement, and capital efficiency. Now let's break down each one of those. Revenue growth. This is about increasing the top line, growing sales through better pricing, new markets, cross-selling, improved processes, digital marketing, or launching a new product. It's not just about chasing the sales, it's about making sure a good PE-backed company will have a clear go-to-market strategy, a well-incentivized sales team, and a data-led approach to customer acquisition and retention. Second was margin improvement. This is where a lot of the heavy lifting gets done. Margins can be improved by cutting unnecessary costs, such as streamlining operations, outsourcing non-core functions, or renegotiating with suppliers. You might also look at product mix, so removing the low margin offerings and focusing on what actually drives profitability. It's about building a lean, scalable business without cutting so deep that you damage the long-term growth. And three was capital efficiency. This means managing working capital such as receivables, payables, and inventory so that it stops cash from being tied up unnecessarily. It can also mean smarter capex decisions. So, are you spending money in the right places? Are those investments paying off or not? The most valuable businesses are the ones that convert earnings into actual cash, and that's what buyers look for on exit. Now, none of this happens by chance. So, private equity firms often create a value creation plan, or VCP. I do touch on this on another video where I go into depth on a strategy playbook and what that means and how that adds value across the private equity when building a strategy. So, the VCP lays out what are the key value levers, who owns them, what needs to happen by when, and how progress will be measured. It usually starts before the deal closes and it hits the ground running on day one. Some VCPs focus on operational improvement, whereas others focus on commercial transformation. Some involve bolt-on acquisitions as a part of buy and build strategy, whereas others, their approach will depend more on the business, the sector, and the investment thesis. Every VCP is built around clear accountability. That means that real owners propel timelines and governance structures will keep them going. Yes, there are always efficiencies to be found, but the firms that create real value are the ones that help the business grow and become better positioned for the future. That could mean investing in talent, launching a new digital platform, entering a new vertical, or transforming the commercial model to unlock pricing power. It's not about stripping the business bare, it's about building something bigger, more focused, and more valuable when you leave it. So, a quick recap. Value creation in private equity comes down to three levers. The VCP or strategy playbook is the blueprint for how that happens. It's built on execution, not theory. And it's what separates the firms that talk a good game from the ones that deliver real results. In the next section, we'll deep dive into the first 100 days after a deal closes. So, section 6, the first 100 days. So, the first 100 days after the deal. Why do they matter? Think of this window like a reset button. It's your chance to align leadership, clarify strategy, and start delivering real outcomes fast. It's also the moment where people are most open to change. The deal's closed, expectations are high, and everybody's watching. They don't know what's going to happen next. If you can show progress really quickly, even in small wins, you build the credibility and confidence that investment thesis is real and people will support you in doing the rest of the transformation. There's three things that must be in place before day one. Now, I do cover this in another video, but I'll really briefly cover it here before moving on to section 7. Now, the three things that must be in place before day one. The right leadership team. You need people in place that can drive performance, not people that will sit in the passenger seat. These are people like the CEO, CFO, and operational leads that have to be aligned, accountable, and motivated to deliver the plan. Second is a clear, consistent narrative. So everyone, from the board to the frontline staff, needs to understand what's happening, why it matters, and what success is going to look like. You can't lead if you can't communicate. And 3, a bulletproof valuation creation plan. This means defined priorities, clear owners, and a roadmap that shows exactly what's happening week by week. This isn't about fancy slide decks or Gantt charts. It's about having a plan that can actually be executed with a team that has bought into it. So what happens in the first 30 days? The first 30 days of the 100-day plan is all about establishing and setting the rhythm. So what happens in the first 30 days of the 100-day plan? This is where I would expect to be establishing a weekly cadence from the leadership team. I would expect alignment on reporting and KPIs. And I would also be kicking off key work streams like pricing, procurement, and sales strategy. And delivering 1 or 2 quick wins to prove the model. Quick wins could be cancelling low priority projects, adjusting pricing, pausing unnecessary hiring, or renegotiating supplier contracts. Nothing flashy or that'll take a lot of time, but it does just prove that things are moving in the right direction. But with this, governance is everything. You cannot run a 100-day plan without proper governance. In my case, I normally introduce and run a PMO. So PMO stands for Portfolio Management Office and often acts as the control tower. So the PMO will track progress, it will look at surface blockers, and it will drive coordinations between the work streams and keep the sponsor on board and management aligned. Without this, things fall apart, initiatives often stall, priorities shift, and communication often breaks down. That just means that momentum's lost. So the PMO isn't about creating admin or slowing things down, it's about creating the focus that's needed to drive things in the right direction. I will do another video on PMOs and how they help private equity, but that does need a much deeper dive and a really focused view on it. I don't think the audience that want to just know about private equity specifically want to know about PMOs, but I will bring a video in the future. So a quick recap, the first 100 days are about pace, alignment, and early proof that things are working. So you want to have the right leadership in place, communicate the plan clearly, execute against a structured, focused value creation plan, put proper governance in place, and test that your team are under real conditions, working towards the right things that will add value. Section 7, the PE playbook for operators. So far, we've looked at what private equity is, how deals get done, and what happens in those crucial first 100 days. But now let's talk about what actually means to be an operator inside PE-backed businesses.
Endurance rotation is 67, 68 RPM.
Okay, get ready to match our spin with the retro thrusters.
It's not possible.
No, it's necessary.
Because once a company is acquired, things do change. Expectations shift, pace increases, and the level of scrutiny goes up a gear. This is the PE playbook from the operator's point of view. So what changes after a deal? When a business becomes a PE-backed business, the day-to-day might not change that quickly, but the way that decisions get made absolutely will do. So if you're an operator in a recently bought PE-backed business, you'll notice things like clearer targets. So you'll have defined KPIs, probably a lot more focus on growth targets, and definitely EBITDA milestones. You'll notice that there's a lot more faster decision making. So bureaucracy goes completely out the window once PEs buy it. They all will just double down on getting decisions made and moving forward. Third is regular board meetings. They do focus on much more board meetings more regularly. And the fourth is more accountability. So there's no way to hide once a PE buys you. You're often scrutinised over the models that a private equity firm will expect. And I do mention that in a few of my other videos, which I'll tag at the top here. So not everything does change though. What stays the same? A good private equity sponsor will protect what already works well in the business. So this could be customer relationships, cultural strengths, and core product value. The best sponsors don't try and run the company, they just support the management team to make better, faster, and more aligned decisions. They bring in tools, frameworks, and experience, but they don't take over where it's not needed. So what do PE firms expect from management? This part's really important. So if you're a new PE company or you've been purchased recently by a PE company, I would expect an ownership mentality. So take accountability, not just of tasks, pace and urgency, don't wait for perfect timing. You will want data-driven decision making, clarity in communication, and you'll notice there'll be a lot more resilience. So things will move quick, priorities will shift, and pressure will change. You might get things like much more incentives. So most operators in PE-backed businesses are given more equity. So it gives them skin in the game, and it means that they are trusted to stay with that firm all the way up until it sells in the 3 to 5 year timeline.
Excuse me.
Yeah.
Is that your car on the lot?
Yeah.
It's a Jag?
Yeah.
You make a lot of money?
Yeah, I do all right for myself.
So working in a PE firm, what's it actually like? The relationship between management and the sponsor is really, really important. Good private equity firms don't micromanage. They challenge, support, and question, but they don't get in the way of delivery. They'll want weekly check-ins with the CEO, monthly updates on VCP progress, and transparent reporting. So the good, the bad, the ugly. What blockers are stopping them from delivering that value and getting that resale value down the line? So if I do a quick recap, if you're stepping into a PE-backed business, here's what I would expect. Clearer goals and sharper reporting, more speed, more pressure, more support, a focus on execution but not noise, and equity upside if you help drive that performance, and a sponsor who will back you when you need it. Section 8, careers in private equity. So maybe you've been watching this series and thinking this is really interesting, but how do I actually get to work for a private equity firm? There are two sides to the industry. One is the fund side, so working inside the private equity fund itself. And the second is the portfolio side, operating inside of a company that's been acquired by a private equity company. So let's start with the private equity company itself, the fund. Careers inside a private equity firm would be working at the firm level, which means you're on the deal team, sourcing, evaluating, and managing investments. So the typical progression is analyst, which is your entry-level role focused on financial modeling, market research, and preparing investment memos, to associate. You've now got a deeper understanding of deals, due diligence, and advising. VP or investment manager, which is when you start owning the managers, analysts, and associates. Principal, which is when you're shaping the investment thesis. And then partner, which is when you're responsible for bringing in these major deals. In the UK, many private equity firms also bring in professionals, which will often have post-MBAs or have worked with the Big Four. I mentioned this on a previous video, which I'll tag now. And we go on the other side, this is careers in the portfolio companies. So you're not trying to join a fund, you want to work in a company that's been recently acquired by a PE. Now, these are normally very senior roles, so you would look at being the chief exec officer, chief finance officer, chief operating officer, transformation director, commercial director, or a program lead or PMO lead working on an initiative that drives a value, which gets them that end sale value. Skills that matter the most on both sides. Whether you're trying to work in a fund or run a portco, the skills that actually matter are commercial awareness. So can you see the opportunity in a business and can you quantify it? Executional discipline. Can you drive initiatives through to completion and not just talk about them? Clarity is communication. PE is a high trust, high pressure environment. You need to be concise, direct, and structured. You need numerical fluency. So you don't have to be a spreadsheet wizard, but you do have to understand cash flow, margin, and returns. And finally, resilience. It is demanding. You will be stretched, but if you thrive under pressure, you'll stand out, and I think you'll really enjoy it. So how to break in? If you're aiming to get on the fund side, the things that I would say will speed up getting in are do an MBA, which relates back to those skills that I've mentioned. Get to know the industry. So sponsors value repeat operators that they can trust. If you start reaching out to the network and connecting with people, they will start noticing and they can start giving you advice on how to, or they can give you advice on what projects are coming up, which you may be a good fit in. You can always connect with me on LinkedIn. My name's James Pearson Garner. I'll always give any help or advice if you come to me and ask for it. If you want to get in on the opco side, I would advise focus on delivery. So program manager, PMO, BA, so business analyst. So we've talked about the positives of private equity. We mentioned about how you buy, build, and sell companies, but I just want to go over the risks and criticisms. So section 9, risks and criticisms of private equity. Private equity gets plenty of criticism. Some of it's fair, some of it's a bit outdated, but I often find it depends what the agenda is of the news article that is talking about the recent acquisition. So, financial engineering versus real improvement. One of the oldest criticisms of PE is that firms don't actually improve businesses. They just load them up with debt, cut costs, and sell them on. Now, this did happen in the past, and it does happen with some certain deals, but it's not very common now.
I want you to deal with your problems by becoming rich.
If the strategy is too focused on debt-fueled returns and not enough on actually improving the health of the business, then it is a problem and markets will notice it. Investors do know that that's the agenda that the person's trying to spin. Still, if the strategy is too focused on debt fueling returns and not enough on the actual improvement of health of the business, then that is a problem, and especially if a market shifts or the cost of borrowing increases. 2 is short-term thinking. Private equity firms usually hold the business for 3 to 5 years, sometimes slightly longer, but it's still a fixed time horizon. And that can lead to decisions that maximize exit value in the short term, but doesn't always set the business up for the next 10 or 20 years. That might mean delaying investments in long-term innovation or holding off certain hires or prioritizing EBITDA over brand strength.
It's a lot of money. I get it. I can feel you judging me. That's palpable. But hey, I never said I was the hero of this story.
The best firms strike the right balance, but not all of them do. And if you're in this business, you are going to feel it. There are certain things that will jeopardize a brand for a higher multiple, but it is rare. Job cuts and culture disruption. So when private equity gets involved, people do get nervous, especially employees. In some cases, it is justified. There's a lot of value creation plans that include cost cutting and restructuring. It often means redundancies, new reporting lines, and major cultural reset. If handled poorly, this can damage morale, it can create high turnover, and it does slow down execution, even if the numbers did look better on paper. A good private equity firm invests in culture, communication, and leadership, but again, not all do. Another one is lack of transparency. So because private equity companies are backed by private businesses, they don't face the same disclosure requirements as public companies do. This can be a good thing because it can give them space to focus, but it does also mean less visibility for employees, customers, and suppliers. This has become a more public issue in the UK, especially when private equity firms own critical infrastructure, healthcare, or housing assets. People do want to know what's going on and who's pulling the strings, and it's not always shown. And the last point is that not all private equity firms operate in the same way. Some are brilliant operators, true partners, and value creators. Others are more financial, focused on cutting costs, flipping assets, and squeezing value out of the structure rather than creating a better business. So if you're joining a private equity backed business or are considering partnering with a PE fund, make sure you know who you are dealing with. Ask them questions, look at the track record, speak to other operators who've worked with them, because the brand on the website doesn't always reflect what it feels like inside the portfolio. So, quick recap. Private equity is a powerful model, but it does come with risks and real trade-offs. It can rely too much on leverage. It can rely too much on prioritizing short-term returns. It can cut too deep too quick. Operating behind closed doors with poor transparency and inconsistent quality across firms. If you understand these risks, you can work with them. If you ignore them, they will catch you out. Right, if you've made it this far, you're officially smarter on private equity. We've covered everything from what private equity is. You now know how firms make money, the types of deals that exist, what to do in the first 100 days, what a value creation plan is, governance, and then what to look out for in private equity. So now that you've got the proper foundation, if you want to dig deeper and really understand more about private equity, please watch the value creation series. I break down how a 100-day plan should work. You get to know more about the structure of value creation workshops and how to diagnose a portfolio company quick. If this has helped you, this is what you need to do next. Drop a like. It tells the algorithm that this is worth watching. Hit subscribe so you don't miss the next episode, and leave a comment. I really want to hear what stood out to you and what you'd like to hear next. This has been a Value Creation series. I'm James Pearson Garner, and I'll see you at the next one. Thank you.